Welcome back to the Deep Dive. Today we are getting into, well, what was probably the biggest economic shockwave of the quarter. I'm talking about this stunning announcement of India's Q2 FY26 real GDP growth. And you really need to hear this number, 8.2%. I mean, this didn't just meet expectations, it completely shattered them.
It really did. Most of the forecasts were hovering around, 7.3% to 7.5%?
Exactly. And the Reserve Bank of India itself was projecting 7.0%. So this 8.2% print, it just immediately solidifies India's position as the world's fastest growing major economy.
And by a huge margin, more than double the G20 average of 3.4%. A number like that, it absolutely warrants a deep dive.
That's our mission today then.
Right. To really understand the primary drivers, but also, and this is crucial, to dissect the statistical quirk that helped deliver such a headline-grabbing figure.
So where do we start? What were the main engines?
Well, there were two big ones. You had the secondary sector, which is largely manufacturing, and then the tertiary sector, services, which is just always so resilient.
Okay, so let's unpack those. What specifically made the number jump so high?
It really came from the industrial heartland. We saw just an exceptional performance there. Manufacturing was surging by 9.1%.
9.1%. Wow. And what was it before?
I mean, for comparison, it was just 2.2% in the same quarter of the previous fiscal year, so that's a dramatic turnaround.
And that's not just a fluke, is it? There's policy behind that.
Exactly. It's being structurally supported by things like the production-linked incentive schemes, the PLI schemes.
Okay, and what about services? The reliable workhorse.
Services continued its dominance, expanding at 9.2%. And within that, you have the hub financial, real estate, and professional services, which was the absolute frontrunner. It posted 10.2% growth.
Those are just massive figures. So on the demand side, who is footing the bill for this huge expansion?
That's where the policy focus gets really interesting. This growth was significantly bolstered by sustained government capital expenditure, or CapEx.
So building things, infrastructure.
Right. And here's the key part. If you look at government final consumption expenditure, that's the typical day-to-day spending, it actually contracted by 2.7%.
So they're deliberately choosing long-term asset creation over immediate spending.
It's a very clear strategic shift.
Okay, so let's get to that statistical quirk you mentioned. We have 8.2% real GDP. Why does the difference between real and nominal GDP matter so much here?
Because the entire headline figure really hinges on this nuance. So real GDP, which is the volume of goods and services, grew 8.2%. But nominal GDP, the value at current prices, grew only a tiny bit more at 8.7%.
Which means the GDP deflator, the measure of economy-wide price changes, was almost nothing.
It was negligible, just 0.5%.
And that low deflator basically passed almost all of the growth through to the real figure, didn't it?
That's exactly it. It statistically augmented the 8.2% number. What it suggests is weak overall pricing power. Even though volumes are expanding, you're selling a lot, but you can't really charge more for it.
And that weak pricing power, that must create a real headache for the government's finances.
It absolutely does. Tax collections depend on those nominal values. The government budgeted its revenues on an assumption of 10.1% nominal GDP growth.
And it's coming in at 8.7%. That's a big gap to fill.
It's a significant shortfall challenge, for sure.
So the numbers are robust, but let's talk about the cracks. What are the threats to this being sustainable?
Well, the primary long-term challenge is probably investment uncertainty. This whole story is so heavily reliant on public CapEx.
On the government spending money.
Right. The big task now is to successfully crowd in private investment to keep the momentum going.
And then there's the other side of the coin, the social challenge, the employment paradox.
Precisely. You have this incredible GDP growth, but it coexists with really complex employment issues, like urban youth unemployment is stuck at around 17%.
So the growth isn't creating enough jobs.
It's that the 8.2% is disproportionately driven by capital-intensive sectors. Think financial services or advanced manufacturing. They generate massive value, but they just aren't absorbing the huge working-age population.
So we're left with this dual reality.
We are. The 8.2% confirms there's great financial headroom, and it's led to upward forecast revisions. But you can't ignore that the momentum is uneven. It's structurally a bit exclusionary.
Which brings us to the big question for this $7.3 trillion GDP goal by 2030. The central challenge seems structural, doesn't it?
It is.
How can policy effectively bridge that education-employment mismatch? How can you boost productivity in those labor-intensive segments, small and medium enterprises? That, I think, is the strategic puzzle this stunning 8.2% growth leaves us with.